You can feel it, can't you? That subtle shudder that runs through markets when the numbers on the screen stop matching the metal in the vaults. Today, reports are rippling across trading desks and private chat rooms that the registered silver on the big U.S. futures exchange has effectively gone to zero. Registered, meaning immediately available for delivery to satisfy those little promises called futures contracts. If that tally holds through settlement, it's not just a chart event, it's a credibility event. Because when an exchange with decades of history blinks on deliverable metal, the next line in the script is one of two endings: a scramble to find metal at any price, or a scramble to change the rules. Let's name the stakes without drama. A futures exchange is a promise machine. You post margin, you take a side, and if you stand for delivery, you're supposed to get the thing you paid for, not a warmed-over IOU or a credit event. Registered silver isn't the same as total inventory. There's eligible too. Bars sitting in the vault that meet standards, but haven't been assigned for delivery. Eligible is potential. Registered is real. And if registered hits zero, it means there's a mismatch between holders of paper claims and the pool of metal that's been volunteered to satisfy them. That mismatch is the fuse. The question is the length. It's funny how market structure hides in plain sight until it doesn't. Traders love to argue price levels, momentum, Fibonacci retracements, the 50-day crossing the 200-day like two speeding trains passing in the dark. But under all that, the heartbeat of this market is the simple physical fact of whether you can hand someone a 1,000-ounce bar and say, "Here you go." And if today is the day the screen says none available, then the story shifts from whether silver breaks $30 to whether the exchange breaks trust. What happens when registered hits zero? In theory, you get conversion. Holders of eligible bars can register them. Someone pays enough, incentives tilt, and metal gets volunteered. But what if the incentive isn't enough? What if the owners of those bars understand something deeper about industrial demand, about the direction of monetary policy, about a multi-year supply deficit, and simply decline to volunteer their lifeboat to passengers still arguing over seat assignments? What if the people with the metal have stopped being weak hands and become strategic hands? Consider what's changed in the last 5 years. Silver isn't simply a precious metal anymore. It's a strategic industrial input. Solar photovoltaics consume enormous volumes of silver paste every year, and the transition to higher efficiency cell technologies like TOPCon and HJT has actually driven per-cell silver usage up before it can be engineered back down. EVs use silver in electrical systems and power electronics, data centers, 5G infrastructure, medical devices. Every new layer of electrification sneaks in a little more of this catalytic, conductive metal. You can delay a jewelry delivery. You can postpone a commemorative coin. But when a factory line depends on it, you pay whatever the market asks or the line stops, and stopping a line costs millions per day. Those who follow this market know the Silver Institute has been printing deficits, big ones, hundreds of millions of ounces in cumulative shortfall over the last several years. Recycling helps, but it's not enough to offset structural demand growth, plus the stagnation in new primary silver mines. Most silver is produced as a byproduct of lead, zinc, and copper mining, meaning it doesn't care about the silver price when decisions are made in boardrooms. If copper is the dog and silver the tail, a $2 rally in silver doesn't greenlight a new shaft. The copper price does. That's how you get trapped supply curves. Slow, sticky, inelastic. And that's before you talk about permitting timelines, ESG mandates, energy costs, pushing all-in sustaining costs higher. The world wants more silver tomorrow, but new mines take 7 to 10 years. The math in this picture is relentlessly simple. Now, layer on the paper structure. You've got a few flavors of claims. Futures contracts, ETFs like SLV and physically backed alternatives like PSLV, unallocated metal accounts in London, and then the actual physical bars. Good delivery 1,000 ounces sitting in LBMA and COMEX vaults. In London, a big portion of metal is held by institutions as a cash alternative. Think of it as a yieldless savings account denominated in ounces. In the US, the futures market functions as a price discovery engine. Most futures traders roll their positions. A minority stand for delivery. This works fine as long as flows net out and enough registered inventory exists to fill delivery notices. But when the seesaw tilts, when more people want metal than want out of metal, you hit the pivot point. A credible way to diagnose stress is to watch the spread between front-month futures and spot to see whether contango collapses into backwardation. Backwardation in a monetary metal is a red flare. People want it now more than later, implying scarcity and convenience yield. Another diagnostic, Watch exchange for physical (EFP) activity. Those little side doors where a Comex obligation is converted to a London obligation. When the EFP window is busy, it can mean the exchange is leaning on London to paper over a local shortfall. But what if London is tightening too? What if bar lists get shorter, or more of what's left is encumbered by swaps, leases, and internal claims? What if the float in the system is thinner than the public ledger implies? Situations like this do not resolve gently. One path is a cash settlement precedent, where the exchange remains functioning, but those who stand for delivery are offered a premium or a deferral or a temporarily unavailable note dressed in legalese. Another path is heroic conversion. Eligible metal volunteers itself because premiums go haywire and the arbitrage is too attractive to refuse. The third path is where it gets spicy. A structural repricing that reprioritizes physical over paper, forcing the futures to chase the cash market and the cash market to chase the hand-to-hand market. That last one is the spark that can turn a catalyst into a conflagration. If you need historical parallels, go to 1980 when the Hunts tried to corner the silver market and forced exchanges to liquidate only, a euphemism for changing the rules mid-game. Prices cratered, the precedent was set. When the big boys feel the heat, rule books grow wings. Or remember 2008 when gold street premiums went vertical even as paper sold off, dealers out of product, backlogs measured in weeks. In March 2020, during the pandemic shock, there was a moment when 400-ounce London bars and 100-ounce Comex bars couldn't easily meet in the middle. Logistics froze, spreads blew out, and spot became a negotiation. In 2011, silver's ascent toward $50 wasn't a tidy trend line. It was a tangle of fear, leverage, and physical tightness. Each time, the lesson rhymed, when the system is stressed, what you own is different from what you can touch. So, where are we on the chart? Even before today's rumor mill went into overdrive, silver had been tracing a multi-year base with multiple attempts at the $26 to $30 corridor, the battleground where tactical funds play ping-pong with long-term accumulators. Call it a giant cup and handle, if you like. Handle formed in the churn between $20 and $26, base built on exhaustion in 2022 to 2023, and then momentum waves beginning to stack as the 50-day slipped above the 200-day and price retested from above. If you pull a Fibonacci retracement from the 2011 high to the 2020 low, that's 61.8% pocket purchase ominously in the low to mid-30s. Prices love magnets like that. Strong moves often overshoot. Above $30, air gets thin and time frames compress, because there's not much trapped supply until the memories of 2011. Above $35, you're playing for a retest of behavioral anchors, and above $40, you're into an open sky where narratives outrun numbers. But all of that technical theater assumes a normally functioning delivery system. If registered metal is truly at or near zero, the script shifts from where resistance breaks to what does price even mean if delivery is in question. At that point, premiums become the real-time data. What are dealers charging for 100-ounce bars? What's happening to the bid on junk silver bags? Are refineries quoting longer lead times? Is PSLV drifting to a premium that signals street scarcity while a synthetic fund prints discounts? The decoupling between screen price and street price is the canary. It sings before the house fills with smoke. Under all of this, a quiet capital reallocation has been underway. Central banks have been dutiful buyers of gold for several years, rebuilding reserves in a world where sanctions risk is now a line item in sovereign risk models. While silver isn't a central bank reserve metal, the psychology spills over. The same logic that makes Moscow or Beijing prefer bars to bills also nudges corporations and high net worth families to consider real assets that live outside the promise pyramid. If you're a manufacturer watching crackling geopolitical arcs, trade friction, energy realignments, sanctions creep, and a hum of conflict, you might not say it into a microphone, but you allocate to inventory. Not as a speculation, but as insurance. And if you allocate to inventory, you call your supplier and say, keep it coming. Or better yet, I'll take next quarter's allotment now. Remember, too, the miners themselves behave differently now. Many have been burned by hedging at the wrong times. All-in sustaining costs have marched ahead with labor, diesel, explosives, crushing energy, and regulatory overhead. If the market tries to drag them into forward sales at a cheap price, they shrug and live within cash flow. Meanwhile, the juniors, the small explorers who would normally be feeding the next cycle, have been starved for capital since 2012, with brief windows of funding every time the sector twitches. A pipeline starved in 2014 and 2015, becomes an empty commissioning window in 2025 and 2026. Even if silver moved to $35 tomorrow, you can't click your heels and teleport a mine out of a feasibility study. The institutional positioning matters. Watch the commitment of traders report not as gospel, but as a map of incentives. Commercials, the bullion banks and producers, tend to be short, and managed money tends to chase momentum. In a typical cycle, commercials supply paper into rallies and buy it back into dips. If the physical pool behind the commercial complex is tight, the appetite to be short at scale diminishes. If the managed money crowd senses a delivery squeeze, they don't just add longs, they front-run each other, and the price discovery engine becomes a feedback loop. What starts as a basis trade can become a social phenomenon. And in silver, where the total addressable investor attention is small compared to equities or even gold, the reflexivity is savage. Let's talk about the exchange. A functioning futures market depends on confidence that longs can be made whole in the thing they bought. If that confidence wobbles, you get self-reinforcing behavior. Shorts try to source metal by registering eligible bars, by running EFPS, by negotiating bilateral swaps. Longs who intended to roll suddenly stand because they fear a premium change. Eligible holders do the math and ask, what future price compensates me for losing my bar today? If the answer is no reasonable price, conversion stalls. That's when the conversation turns to alternatives, extensions, deferrals, or the dreaded cash settlement option. The exchange won't call it default, of course. Default is an ugly word that breaks things. But if you came for metal and left with money, you experienced a default to promises, not an outright default in the legal sense. Markets remember the difference. If you're thinking, is this really happening? You're asking the right question. Sensible investors verify. The clever part isn't knowing whether a website flashed 0. It's reading the whole tape. Vault reports trends, bar list net changes, new warrant issuances, EFP traffic, dealer premiums, refinery schedules, and the behavior of spreads during the roll. It's listening to the tone from big wholesalers. It's watching India's imports. Those shipments are the belly of the beast because Indian demand swallows silver like a whale swallows krill. When India is heavy on import, rest of world tightness shows up faster. And then there's China. Silver flows in and out behave differently there, tied to local industrial use and the cadence of manufacturing cycles. If both giants are absorptive at the same time, the West feels lighter. And a lighter West plus a heavier East often equals fire drills in New York. The monetary overlay matters. The post-2020 era is defined by debt loads that refuse to shrink, deficits that refuse to constrict, and policy rates that did something unfashionable. They went up. When rates rose, models said, strong dollar, weak metals. But the second-order effect is more interesting. Higher rates exposed fragility. Who can roll their debt at 6%? Who can't refinance without raising equity? What happens to tax receipts in a slowdown? The deeper the structural hole, the more attractive the idea of neutral reserves becomes. Gold has been the prime beneficiary, but silver has a way of turning a gold trend into a silver sprint. It's volatile because it's thin, and it's thin because it's both monetary and industrial, a split personality that alternates between introversion and mania. There's also a behavioral pattern unique to silver. It sleeps for years and then wakes up ravenous. In 2004 to 2006, it doubled. In 2010 to 2011, it went parabolic. Meanwhile, during quiet years, 2014, 2015, 2018, it washed out the faithful. The reason is reflexivity. Once price starts moving, narratives rush to fill the vacuum, and each narrative recruits fresh capital. Technical traders chase the breakout, macro funds buy the inflation hedge, industrial buyers stretch purchasing to front-load inventory, retail investors grab bars and coins, and YouTube lights up with to the moon while dealers' phones melt. That stack of causes produces effect, and effect becomes cause. When registered is scarce, the normal dampeners don't work. Picture a trading desk this morning. A junior trader minimizes a meme stock window and flips over to the metal screen. He's not a silver guy. He's a rates guy, but he saw the chat ping. Reg. At 0. He pings his contact. Can you deliver? The reply takes longer than usual. Meanwhile, a mid-level risk manager glances at a report on swap book exposure and wonders if the physical desk can cover a squeeze. In another building, a procurement manager at a mid-cap solar manufacturer forwards a note to the CFO. We may want to add 2 months of silver inventory, premiums rising. It's banal. It's not a movie. But the accumulation of banal decisions is what creates non-linearity. That's how squeezes happen. Not from a single hero trade, but from 1,000 tiny, better safe than sorry choices. Technically, if silver clears $30 on a closing basis and does it on rising open interest, the probability-weighted outcome isn't a tidy 10% move. It's an air pocket move with forced participation. Watch RSI during that break. If momentum runs hot, you don't fade the first extension. You let it breathe. Watch the 21-day EMA climb. A clean trend in silver respects that line like a mountain runner follows a ridge. And don't ignore gold-silver ratio behavior. When the ratio starts collapsing, say it moves from 85 towards 70 in a sprint, it's signaling a leadership transfer. In those phases, miners lever up the metal. Quality names with clean balance sheets get bid. Marginal names get their day in the sun too. But those are darts you throw only if you accept that the dartboard can spin back at your face. Fundamentally, the silver story compresses to 3 lines: deficits, delayed supply response, and inelastic industrial demand. The deficits are arithmetic. The supply response is calendar-bound. The industrial demand is price inelastic at the margins, because shutting down a fab for lack of silver is costlier than paying up $1 per ounce. That's why you can see silver soar even if coin buyers hesitate at higher premiums. The industrial buyer doesn't love paying up, but he will. And in a world where the energy transition is turning into policy religion, there's not going to be a lot of patience for factories that can't source metal. That means policymakers may quietly prefer higher prices to scarcity. Because price is a tax you can pay, scarcity is a crisis that pays you. There's a meta-story here too. Since 1971, we've been living in a world where promises proliferate faster than the things that anchor them. Promises are easy. They take no space in a vault, and they pay underwriting fees. Things are hard. They must be discovered, mined, refined, moved, and guarded. Every so often, the world remembers that a stack of promises without enough things behind it is less a balance sheet and more a suspense novel. If today's registered tally truly ticked to 0, it's a reminder, a plot twist that says, check the vault, not just the screen. Even if this specific event is patched in a week by fresh registration, the signal has been sent. Owners of metal just learned something about their bargaining power. Owners of paper learned something about theirs. Quick aside, if you're sitting on $100,000 or more in retirement accounts and you've been wondering how to hold real metal in a tax-advantaged way, I put together a straightforward guide that walks through how gold IRAs work, including how people get physical allocated without triggering penalties. It's in the description if that's relevant to your situation. It's not for everyone, but if peace of mind matters to you as much as performance, it's worth a skim. Okay, let's get back to the mechanics here because the next few weeks could move fast. There's a corner of the market most people ignore: lease rates and time spreads. When lease rates spike, it's often because holders are reluctant to lend metal into the system, or because borrowing demand from shorts has increased. Elevated lease rates can translate into quirky time spreads where the front month trades stronger than it should, and that's your backwardation tell. Watch also the behavior of refiner schedules. If turnaround time stretches from 2 weeks to 6, that's a depth sounder pinging off the seabed. And watch premiums regionally. U.S. retail premiums can be noisy, but wholesale 100-ounce bar premiums are a cleaner read. In Asia, premiums tell you how much appetite is outpacing local supply. If both are rising simultaneously, it's not a marketing phenomenon. It's inventory theory at work. A more arcane signal, the behavior of ETFs. Sometimes the share price of a physically backed vehicle trades to a premium. Investors are bidding the wrapper because the creation-redemption mechanism is constrained. If you see sustained premiums, it implies holders prefer the wrapper to the paper claim. The inverse can happen too. Synthetic vehicles can trade at discounts as investors vote with their feet. In prior stress windows, we've seen days when metal should have been easy to source according to the ledger, and yet premiums said otherwise. In those windows, sophisticated players do something simple. They ignore what's supposed to happen and trade what is happening. If this moment morphs into a broader repricing, a strange thing tends to occur. People who thought of silver as a hobby wake up to the reality that it was the smallest portion of their portfolio with the largest amount of conviction. They'll wish they had spent more time understanding custody instead of price predictions. They'll learn vocabulary words, warrants, eligible, registered, EFP, lease, like a crash course taught by a market with no patience, and they'll make a decision. Either step closer to the asset and learn how to own it properly, or step away and accept that their exposure is a sentiment instrument, not a claim on a bar. Neither is wrong. What's wrong is not knowing which you own. Let's be fair. These systems don't collapse easily. Huge institutions have reputations to defend and resources to mobilize. If there's a path to reliquify the registered pool by offering incentives, they'll find it. Maybe a few million ounces appear as owners decide the price is right. Maybe London helps smooth the bump. Maybe the storm passes and this becomes another ghost story told by silverbugs to frighten the uninitiated. But even if this specific stress is resolved, it alters trajectories. Owners of metal feel validated. Owners of paper adjust their risk model. Industrial buyers think twice about just-in-time inventory. Miners reconsider their hedging playbooks. And the next time a stress signal flashes, the threshold for panic is lower, not higher. What could break the tightness? A recession sharp enough to dent industrial demand could slow the burn. But remember, policy would respond, and stimulus response reinvigorates metals. A surprise mine ramp? Possible, but unlikely to outpace structural demand. A technological breakthrough that dramatically reduces silver loading in solar cells. That can happen over multi-year arcs, not overnight. Meanwhile, the world keeps building more panels, more EVs, more everything. When a variable declines per unit but units explode, aggregate demand wins. Let's imagine two scenarios from here. Scenario 1. Registered inventory is replenished quickly as eligible holders step in, and price reacts but doesn't explode. Silver pushes through $30 and bases between $31 and $34, absorbing supply and consolidating. In that lane, the next few months look like a grind higher. Miners begin to outperform, and the market sets up for a second leg move toward the mid-30s. Scenario 2. Replenishment doesn't materialize meaningfully. Premiums run, spreads invert, and a cash settlement option appears with incentives. In that lane, the screen price becomes deceptive. Street price leads, and we lurch into the high 30s as a discovery process more than a rally. Miners behave like call options on continuity. They gap up, they gap down, they shake the tourists off, and leaders with strong cash flow widen the gap over marginal names. In both scenarios, the long arc bends upward because deficits do not vanish on command. How do you risk manage this as an investor? You decide whether you're buying metal or buying movement. Metal is allocation. Boring, heavy, soothing. Movement is speculation. Fast, loud, clever.